Federal Reserve releasing the first part of its annual stress test for the big banks just moments ago. Leslie Picker's back at headquarters with all the details. Hey, Leslie.
Hey, Melissa. The Fed says the largest and most complex banks in the U.S. are well capitalized. The central bank feels confident that the banking system could withstand a severe recession and continue lending during that period. Fed Vice Chairman Randall Quarles saying in a statement the nation's largest banks are significantly stronger than before the crisis and would be well positioned to support the economy even after a severe shock. An indicator of banks' financial strength or their common equity Tier 1 capital ratio declined from an actual level of 12.3% to a minimum level of 9.2% in the stress scenario. Among the big six, Bank of America was the most capitalized during the test with common equity Tier 1 capital ratio of 9.7%, while Goldman came in toward the low end at 7.6%. But all banks handily surpassed the minimum of 4.5%. Largely, the results were comparable to previous years, but a change in the banking law meant that only 18 firms were tested, almost half as many as last year. Comparing those same firms to show how they did last year, though, the Fed says losses in the stress scenario would be about $410 billion compared with $464 billion last year. The Fed tested a 10% unemployment rate, a decline in the U.S. yield curve, and appreciation in the U.S. dollar. Now, next Thursday, we'll see part 2 of this test, where the Fed will provide more details about its quantitative results as well as qualitative results. Mel.
All right, Leslie, thank you. Leslie Picker back at headquarters. Obviously, this is just the first round, and as Leslie had mentioned, it's the next round that's more consequential in terms of capital return plans, et cetera.
Listen, we know that, and Chip says this all the time, the banks are as well capitalized as they've ever been. Balance sheets look great. I mean, there's no indictment there at all, but that's not the problem, in my opinion. The problem is really how they make money going forward. I mean, the margins continue to contract, and banks are utilities. So I'm not saying you go out and blindly short these things, but I don't really think they're going to race up to the upside as well. So tangible book value in my world is where these banks should trade.
I think the best days for the banks are behind them. So if I look at it, I bring it back from the 50,000 foot up level. The XLF from June of 07 topped out at 30.97. The XLF in March of 2018, 30.32. So that to me is a striking double top on a chart. And then you have the inverse yield curve. The rates are going no place. The banks are going no place. The reason why they spiked up to the highs were deregulation and tax cuts. Those things are behind them. So I don't think the banks have anything to really look forward to other than what Guy said, their utilities, maybe safety.
From the woods to the pond.
All I'll say is, so, you know, it's hard for me to get up here on a box,
Soapbox.
And tell you that banks, you should be buying them just for the balance sheets. But I'll tell you, for all the bad news banks have had to digest in the last 12 months, they've underperformed the S&P by all of about 550 basis points. I realize it's underperformed by 550 basis points, but guess what? The yield curve went almost negative. Banks have had a series of headlines in terms of their core business models being attacked. Guess what? All these IPOs, if you look at their capital markets businesses, I actually think you're going to see some surprise to the upside, both on sales and trading, because of some of this volatility. And the deal flow that's been coming through Wall Street is as good as it's been in many, many years. Don't discount that at earnings season.
I'm a seller of the banks. Everybody my friends that are in sales and trading are telling me that is a dead business right now. It ain't happening. So you get out of the banks.